Hey traders, a very warm welcome to you. So today in this video, I want to quickly talk about what is a cross pair, what is an exotic pair, what is a minor. I'm going to touch on a major. We've done this before in other videos, so if you want to go and check that out, you can. So I'm not going to spend too much time on the majors, but I do want to look at the exotics, the cross, and I also in the latter part of the video, should I say, want to talk a little bit about choosing your currency based on your trade idea or your trade thesis. Now, it might go into a two-parter, but let's see how we get on. Okay, so we know that the majors are United States dollar from the US, Great British pound from obviously Great Britain, Japanese yen, euro, Swiss franc, Australian dollar, Canadian dollar. So the biggest ones, and euro US dollar, by the way, accounts for 30% of all currency traded. So it's a big, hefty amount of volume. And US dollar, I believe, someone can correct me if I'm wrong in the comments, but we're talking about 80 to 85% of all money flows through US dollar somehow. So it's pretty important. This is why they're called the majors. So it's the major economies paired against each other. Euro, US dollar, JPY, GBP, US dollar, Swiss franc. And then we've got what's called the commodity currencies, which are this little block here. They're called that because the country has a lot of assets in commodities. A lot of the economy is built on the commodity foundation. So we've got Australia against US dollar against Canadian dollar, and then New Zealand dollar against US dollar. So commodity currencies there. Just as a quick reminder, guys, and I've done a bit about this before. If we're looking at a quote that says, let's use something different than we normally would. Let's go with US dollar JPY, USD JPY, so we can't cheat. Let's say the quote we're looking at is 112.5, whatever it is. What does that actually mean? So very, very quickly, remembering that the first thing we look at is basically how many, if we have 1 unit of the first currency, how many of the second currency do we get for 1 unit of the first currency? So in other words, this is saying, hey, how many Japanese yen do I get for 1 US dollar? If I went and presented 1 US dollar, how many Japanese yen would I get back? And this is the important thing to remember when you're trading currencies, is that you're not trading a specific currency on its own. You're trading it in relationship to another. How does it move relative to? What's the value of it relative to another currency? So we'll come on to this in a second about picking the right currency for the trading idea you've got. But this is telling us, hey, we're going to get back 100 and... if I can draw the yen sign, close enough, right? If I have 1 US dollar, I'll get 112 and a half Japanese yen back. So that's just the main thing to remember when you're talking about currencies. Okay, we've done that, we've covered that before. Let's not dwell on that too much. Right, let's look at the minors. What do we mean by minor or cross? Well, minor or cross, same thing. Basically, the cross is being able to trade a major economy without having to go first into US dollar. Because at the beginning of the Forex market, you would have to trade, let's say you wanted to buy Japanese yen, you wanted to trade pounds into yen, okay? You would have to do pounds into US dollar, and then you would have to do US dollar into JPY, into Japanese yen, to get your yen. You have to do 2 trades, and it was more hassle for brokers, all this kind of stuff. But when the economies are decent size, and there's decent liquidity in the pound, there's decent liquidity in the yen, they came up with the idea of saying, hey, listen, let's do a cross trade, and we'll call it the cross because it literally crosses over, it gets rid of the US dollar. We don't have to do 2 transactions. We can literally transact straight from pound to yen, or from AUD to yen, whatever it may be, just ignoring the US dollar component of it. So a cross is when you have the major economy trade, or major economy or country trading with another one that doesn't include the US dollar. Okay, something to point out before we move on to some of the exotics is that as you kind of go down the tier or scale of liquidity, then spreads are going to be larger, cost to carry will change, and that doesn't necessarily represent the liquidity, that's to do with the interest rates, but we've done a video on that, and we'll do another future video on that. But you've got to be cautious of how much it's costing you to trade, the liquidity, all those kind of things as you move down the scale of the less liquid or less frequently traded currencies. Okay, let's move on to the exotic pairs. I've just got a handful here. There are loads of exotic pairs, and they literally cover, if you look on a global perspective, the economies that aren't as strong as some of the bigger ones. Now, obviously, there's some strong economies here, but when you're ranking them in scales of, United States, Japan, Britain, Europe, all that kind of stuff, then these are further down the scale. So you have Turkish lira, Hong Kong dollar, Norwegian krona, Swedish krona, South African rand, Mexican peso. You've got other things, Polish zloty, all sorts of kind of stuff. So the exotic pairs are going to be pairing these against the US dollar. So you have things like, if I missed any big ones out there, we've got Singapore dollar, I could have put in there, Danish krona, I could have put in there. There's a massive amount of them. But let's say, for example, you wanted to trade euro against the Turkish lira. That would be an exotic pair because you're pairing off a big major economy or major currency or major country against an exotic, and that's going to be a much bigger spread. You've got to be a little bit careful about how much you're paying to be able to get that exposure to the Turkish lira, to the Hong Kong dollar, whatever you want. Now obviously, again, going higher up the scale in terms of liquidity and in terms of how much volume they're doing, the spread is going to be tighter. What you've got to be very careful of, and many brokers don't offer this, if you start pairing exotics with each other, then it just becomes like a cross. And you can imagine, as we sort of talk about going down the scale, it's sometimes not even offer that kind of thing, and you really are into real territory of just so little liquidity. They sometimes, in fact, sometimes guys, the brokers will literally have an updated print every kind of couple of hours. It's that illiquid, so you don't really want to get involved in that. You really want to be, if you're going to trade the exotics, you want to trade them off against at least some of the majors, and probably want to be sticking with US dollar. One thing to point out quickly is, if we are trading, if we believe that one country is going to be weak, then we are better off from a perspective of trading, of getting the most bang for our buck, if you like, pairing that against a country that we believe to be strong. There's no point in pairing two weak countries together, because it's like a pair trade. They're both going to be weak. The actual currency pair is not going to move, or the value of the pair is not going to move. If you've got one really strong currency and one really weak currency, that's when you're going to get your big move in that FX trade. So it's something to bear in mind. And actually, if you go and check out some of the Market Wizards books, like Hedge Fund Market Wizards, I believe it was, there was one of the guys in there who talked about his his thesis on US dollar, and he ended up basically doing a lot of due diligence and working out that actually the best pair to trade it against is none of the biggest ones. It was going to be Turkish lira, because that happened to be like the strongest currency out there, and it couldn't hold its ground and all that kind of stuff. So we're not going to go into this video, but you need to understand, if you're going to pick something from a swing trading perspective, it's far better, because of the nature of the pair. You're buying a strong one, selling a weak one, or you're selling a weak one, buying a strong one, whatever it may be. That is going to give you far more movement if you have this swing in that direction, as opposed to just both being strong or both being weak. Okay guys, major, minor, cross, exotic pairs, something to think about. Loads more research you can do if you like that kind of stuff. Google it, look for exotic pairs. They're worth looking at. And actually, on a last note, you can find some little opportunities, because not many people are watching these things. And I have to admit myself, I very rarely scan for opportunities on this. But actually, if the spreads are reasonable, and there's something going on, especially if you've got something with the major economies, this might be very, very strong somewhere. One of these might be very, very strong or very, very weak, and it gives you a kind of good opportunity when pairing off with some of the big boys. So something to think about. Anyway guys, see you in the next one. We're talking more about forex pairs, forex trading strategies. Take care. Bye bye.